I'm Kevin McKenzie, the head of product marketing at Prodigal. And today we're going to be taking a look at how to handle the top threats to auto finance operations. So I'll introduce our panelists very shortly. You can see them right now. They're up in those top video boxes, but we'll get to those intros very shortly. Then what we'll do is go ahead and identify the top threats to the industry that we're seeing today and explore some ways to overcome those threats. And with that, I'll go ahead and welcome our first panelist, and that's Pushan Gupta. He's the CEO of First Help Financial. That's an auto finance company that serves thin file customers with limited access to financial services. So welcome to the webinar. Would you like to share a little bit more about yourself and also First Help Financial?
Sure. Thank you for that, Evan. So, like the description says, we serve thin file customers. I'm a relative newcomer to the industry. My experience with auto finance started with First Help about 9 years ago. We were a scrappy little auto finance company based out of Massachusetts with about a $35 million art portfolio. And obviously, in the last 9 years, we have expanded from just being a Massachusetts-based player to now I think we have a presence in about 28 states, portfolio of about $800 million right now. And obviously, there's a lot I've learned along the way, and a lot of it from some folks on this call I saw that I know from the last few years, and then interacting with different people in the industry. So I hope that in this webinar I get to share some of my experiences and also learn from the folks on this call.
Great. It's perfect to have you with us today. And also, we have Mike Lavin with us, the president and COO of Consumer Portfolio Services. And they're a specialty finance company that provides indirect automobile financing. And Mike, would you like to tell us a little bit more about yourself and also CPS?
Sure. CPS has been around for 31 years. We're one of the bigger players in the subprime auto space. We've originated over 21 billion in auto contracts in our 31 years. We've done 97 securitizations in the ABS market, with all of our investors getting back their principal and interest on every deal, including we've been through 2 recessions and COVID. We are a profitable company. We've issued 47 straight profitable quarters. Our current portfolio is around $3.1 billion, and our portfolio performance is still quite good, considering the sort of choppy economic headwinds that we're all facing in the industry.
Yeah, definitely. Thanks for being with us today. So now that we took a second to get to know the panelists a little bit, we're just going to have a quick poll question for the audience. So I'll go ahead and launch that now. So I know that everybody that's on now, so you can see these results coming in real time. So we'll move kind of to the question where we're looking at, based on what we're seeing the audience saying, is any of that surprising for you, Mike? Would you expect to see what they're saying? It's kind of right now spread across all the options, if we're being honest. And does that ring true to you? Is there really one threat that stands out to be worse than the others, or are they all kind of?
So looking at the poll, it looks like rising delinquencies is head of the game. I just got back from 3 days at the ABS West SFX Securities Conference, and talking to all the bond investors. Clearly, their view of the biggest threat to our industry is portfolio performance and rising delinquencies. So I would say that the participants today are on the right track.
Got it. And Pushan, would you agree? Do you think that that's probably the biggest threat that you've seen, or something else that you'd like to discuss?
I think I would completely agree with Mike. I think rising delinquencies is going to be the flavor of the year in 2023. A lot of the issuances from early 2022 or mid or late 2022 are struggling to perform. You look at where the base cases were for the loss curves, many of them are above their base cases. And I think 2023 is going to be an interesting year where we will see which of those issuances are put under watch, which of those tranches are downgraded. And when you combine that with kind of the second thing that the audience has indicated, which is an interest rate pressure, it's going to be a challenging year for issuances, because you've got interest rate on one side and you've got credit on the other side, and they are kind of both pressing against each other. So I think the answers are spot on. And definitely something that I would agree with.
Sure. And maybe, Mike, taking a look at some of the examples that we have here listed, are there any threats that we left off or something that comes to mind that we should have included here that you've noticed has been a challenge, or pretty much everything seemed to be
No,
captured?
everything seems to be captured. I mean,
Yeah.
specifically for us, and this goes part and parcel with rising delinquencies. One of our biggest challenge right now is keeping the monthly payment affordable for the customers. That's especially true given the macroeconomic headwinds, which includes, inflation, rising rates, recession talk. And so for us, we aggressively raised our rates from 16% to 21% over the last 9 months, which obviously bumps the monthly payment up. We're right around $524 now, which is under the used car price average of 544. But of course, that's much higher than our average, sort of historical at around 400 to 425. So, how do we keep our payment affordable for our customer, who's the average Joe, which is probably Pushan's customer too, um, who typically live paycheck to paycheck, while
Mhm.
trying to remain profitable. Our cost of funds has gone up with rates rising, so our yield and our margin is being pressured. So we're sort of balancing, you know, I guess not ripping the customer's head off with high interest rates and high payments versus, tightening credit and remaining profitable at the same time. It's a big time balancing act.
Yeah, it sounds challenging to have to handle that. And if we look at the list of these threats here, maybe Pushan, is there anything maybe this year that you're less concerned about? So all of these we've identified as challenges, but maybe just for this year in particular, anyone that's maybe less of your focus that you're a little less concerned about going into this year?
So one thread that you don't have here, and we can discuss how serious it is
Mhm.
going to be, is basically around used car prices. So we all know how the Manheim used car index has gone down from where it was in January of 2022 to where it is right now. Now, last year the decline was pretty steep. Obviously, we have seen a reversal in the last couple of months. So January used car index was a little bit higher. So question mark is that will it remain as much of a factor in 2023 or not? So I remember in last year's securitization transactions, the questions that investors would ask is that how are you dealing with used car prices going down? I'll be curious to see how they think about used car prices this year and whether they go down at all. I think and the general consensus is that used car prices are not going to see the kind of decline that they saw last year. Uh, Primarily because new car inventory is still tight, and the OEMs have come back and said that it's not going to materially change over this year. So I think Moody's put on a paper saying that they don't expect the used car prices to go down too much this year. So yeah, I mean that's a threat which was top of mind last year, but not as top of mind this year. But again, we'll see as the year progresses whether it comes back up as a top of mind issue or not.
Yes, definitely. Yeah, one thing that I don't think we've discussed so far is customer expectations. Mike, maybe do you have any thoughts around that? So perhaps the idea that with people getting more and more comfortable with basically a seamless e-commerce experience, everybody expects something to be simple, easy, just fast, anything like that. And if they can't get it from you, they'll try to look for somebody else, and that can make things difficult, I'd imagine. Any thoughts? Have you experienced that
I mean,
firsthand?
not really for CPS. I mean, our customer is a subprime
Hmm.
customer, so I don't want to say
Yeah.
we're a lender of last resort because we don't go that deep into
Hmm.
the space, but we are a lender of necessity. People need their cars to go to
Yeah.
work. The payment of the vehicle is at the top of the waterfall with people's paycheck. Therefore, their expectations of us are a lot lower than, say, a prime customer whose credit leverage allows them to shop their lenders. For us, they need us, I would say, more than we need them. But that doesn't mean that we want to create a poor experience for them, because the better experience we can create, the more apt they are to pay us. So that means a frictionless
Def
experience, giving them 8 ways to make a payment, allowing, giving them the technology to get a text message, click on a link and make a payment with, 4 touches. That is a good experience. Having a sort of an artificial intelligence, machine learning black box on the servicing side, which tells our collectors, how to contact the customers, when to contact them, how to contact them. So we do more with less contact. For example, in 2019, we made 840,000 outbound calls to collect the debt. In 2022, we made 410,000 outbound calls. So we're collecting better with less contact, which makes a better experience for our customers.
Sure. Makes a lot of sense. So I think with that, we'll switch to the other side of the coin, which is we've identified these threats. Now, more the focus on how can people overcome them. So if we think about that for a second, perhaps, Pushan, has there been anything in particular that you've been trying this year that you've seen good results from? Or for last year, something that you perhaps tried that didn't give you the results you're looking for? Or has it more or less been status quo? Basically, you're trying something new, or what's working for you?
I think the challenge with auto lending is that by the time the issue comes to the surface, you already have the book that you have. So you have to always think a little bit ahead to be ahead of to be able to overcome the challenges that come up. And for us, it's how we overcome the challenges today. I think the die is cast. We have the book that we have. Our cost of capital is locked in where it is locked in, and there are some changes we can make to practices on the sides that can help, but there's not a lot we can perhaps do. So now looking forward, what we are trying to do is obviously looking at the two top challenges. Interest rate pressures very serious, so we are kind of looking at alternatives, right? So essentially, obviously securitization is a kind of the driver for funding. Now we're looking at if there are other ways to secure capital, whether it be through loan sale transactions or something else that might help, or expanding the network of investment banks that we work with, which can provide us with a warehouse line. On the delinquency
Yeah.
side, obviously, something we have been saying from last year: staff up, have enough people to make outbound calls, use technology to the extent possible to rack and stack and prioritize the customers that need to be contacted. Something that Mike mentioned, where from 800,000 calls, you're doing 400,000 calls, and obviously without any substantial degradation in performance. Now that's a win, and we are kind of trying to do the same. Bring in some models to be able to predict who are the early stage delinquencies who need not be contacted. Obviously, make sure that customers have every means of payment available to them. If a customer wants to make a payment, then it shouldn't be that I don't know how to make a payment. If there's a way in which you want to pay, we are there to take it from you. Like we have to always be there to take the money from the customer if they want to make the payment. So for that, using a wide array of technologies. So 7-8 years ago when I started, most people would be like, oh, the customer's going to send me a check, or our customer's going to take the cash to a Western Union, or I forget what else, like some very like antiquated stuff. Now there is a lot of technologies where they can pay a CVS or a 7-Eleven apps, any which way they can make the payment. We should be in a position to collect it, and we are investing in all of those things. Now, for some of
Yes.
us small enough who did not have an outsourced, kind of like an international call center, basically based out of somewhere in the Caribbean or whatever, that is something which we are now at a size, and given how delinquencies are going, we're looking at if we need to ramp up. Now most of the larger established players obviously have had an international call center for a long time, so labor constraints is not a big consideration for them because they're always able to expand internationally if they need to. But again, if you don't
Got it.
have one, then this would be a good time to look at it and expand.
Yeah, that's interesting. Yeah, Mike, I'm curious on your side, are you considering some similar things like perhaps hiring more people or expanding your presence or anything else? What are you actually considering to overcome some of these challenges, particularly as they're going to surface this year? Anything different from past
So
years?
for us to offset the rising delinquencies, specifically the 2022 vintages, we have done and had a platform that Pushan stated, which is a nearshore platform. And it gives
Sure.
us the ability to scale up quicker and hire, say, 100 agents within 45 days. You just can't do that domestically. It's nearly impossible, especially with today's labor market. I see that, the participants do think labor constraints is a problem. It is a problem, but there's ways to work around that. One is to do a nearshore platform. It's been very successful. The other is to leverage technology to get more out of the collectors that you have. For example, you've got rising delinquencies, so you probably want to communicate a little more frequently with your people to see what's going on, to see if you can give them a resolution to maybe some financial problems they have. And so our average accounts per collector is right around 675. We'd like to lower that with the economic headwinds we have to around 525, and you do that by throwing some more experienced bodies at the accounts, near shore, and also technology. Obviously, this is a Prodigal webinar. We are adding Prodigal. We think part of the ROI for that product is to allow our collectors to make more calls per hour. And when you do the math on 500 collectors, that ramps up pretty quickly.
Yes, makes a ton of sense there. Thanks for sharing that. And now it looks like we are getting some questions, so we can move on into that portion. And I think the first one here I could probably direct to you, Pushan, to see if you're experiencing this. And there's curiosity around, especially with more people working from home. Maybe there's fewer people commuting, so perhaps they're less incentivized to pay to keep their vehicles that are just sitting in their garages that they're not using as much. Maybe specific regions you see that more or less. Have you noticed an impact from that with people that are commuting less and maybe working from home and less dependent on vehicles?
So I think dependency on vehicle is a very important factor to making a payment. In previous analysis, we found that folks who could get to work without having access to that vehicle tended to have a higher delinquency, higher charge off. Uh, but more recently, we are not seeing that, or at least I'm not seeing a discernible difference, primarily because our portfolio is very focused towards blue collar workers. They make up almost 80% of our portfolio, so maybe even more. So I'm not 100% sure if I can say that we have the data set to be able to do this analysis and slice and dice it. Uh,
Mhm.
but it is just tourism. I mean, there will certainly be a difference between folks who needed the car before and now don't need it anymore.
And I'll add
Yes.
I'll add on to that. We do have the data set for that. We've analyzed it,
Mm.
and majority of our customers are in service jobs, manufacturing jobs, and warehouse jobs, and so they're
Sure.
simply not working from home.
Yeah.
Um,
Mhm. That makes sense to me. Okay. And curious as kind of a follow-up to that, because you mentioned with the pressure with rising payments for the actual consumers themselves, I'm wondering, are you seeing people then buying more affordable economy vehicles, or are they just stretching themselves even farther to cover these payments and get the vehicles that they really want, whether those are trucks, SUVs, or have you noticed a change in basically buying patterns because payments have been increasing and interest rates have risen?
So we haven't seen that really. So our used car,
Hmm.
our average amount finance continues to tick up or stay stable. We have not seen a
Sure.
discernible decrease in the average amount financed. Partly it is because folks have a little less down payment to make, and that's pushing the price up. But overall, if our customer base has not changed, then I would say that the collateral has not changed, which would bring down the amount financed.
Sure. Okay. Yeah. Hey, let me see here. So then also looking at the differences that you run into with servicing and collection based on the type of vehicle. So thinking about that, if you see someone who purchases a truck, sedan, luxury vehicle, economy car, something like that, is it more likely that one type over the other is going to be easier to work with from a collections perspective or servicing, or any thoughts around that? Perhaps maybe direct that to you, Mike, if you want to take
Yeah, I
that
think,
one.
since we've been in business for 31 years, we always believe that, sort of the Hondas of the world were better performing collateral. But we sort of had a shift, I would say 4 or 5 years ago, in that thinking, where light trucks and SUVs actually perform the best amongst our portfolio. Therefore, we made some credit concessions for light trucks and SUVs to get a higher percentage of our portfolio of those cars. We still have Hondas. I think Kia is our most financed vehicle in our portfolio. Those perform great. But a shift to light cars and SUVs is actually performing better.
Ah, okay. Pushan, do you know, have you seen anything comparable on your side, or is there not a noticeable shift?
So again, our portfolio is relatively young, and about
Yeah.
80% of our portfolio, maybe even slightly more than that, is actually between
Mm,
trucks and SUVs and Japanese sedans. So essentially, the
hmm,
segments that Mike mentioned, you know.
yeah. Okay. That's interesting to see. Yeah, I'm curious too, looking at thinking about trends again too. So no, I like, especially with the prevalence of like rideshare services, like things like, of course, like Uber, Lyft, all of that. I've heard before that maybe younger drivers are putting off getting cars or perhaps not getting them at all. Have you noticed that or seen an impact or shift in the perhaps like the age demographics of who's getting cars, or maybe not seeing as many cars sold to younger people? Or is that just not true? Because I know you'd mentioned based on the types of jobs people have to get to them, and Uber and Lyft can be expensive. So maybe, Mike, do you have any thoughts on that?
I mean, we I disagree with that premise. I don't think
Got it.
age matters amongst our applicants for our product. Like I said,
Yeah.
we are a lender of necessity, and so there's no discrimination on age. And
Oh,
I
definitely.
think we do have a gig economy program, but it's lightly used. Um,
Mm,
we have a first-time buyer program. It's a smaller percentage of our overall portfolio. Um, but no, I don't think that's true in analyzing our portfolio.
sure. Yeah, that's valid to understand. Pushan, would you say similar to that
Yeah,
end,
I
or?
mean, very similar. We are actually, our customers are not the ones who are using Uber and Lyft. Our customers are the ones who are offering those rides from time to time. We actually try
Got it.
to clamp down on usage of our collateral for Uber or Lyft, unless you have a programmatic
Hmm.
approach to it. Like Mike just mentioned that he's got a gig economy program. Then you can design the constraints in such a way that you can control the risk. If you don't, then essentially
Yeah,
the collateral is going to get beaten up. We didn't see enough of a volume to design a program, and what we do now is when we do the income verification, if we see a large part of the income is being derived from Uber or Lyft or some kind of gig economy that requires you to use your vehicle, then we usually, tighten the program or decline it or whatever it is,
I see. Yes, definitely. Okay. All right, let me see here. Have another question that says, besides interest costs, which we know are increasing, how are other cost buckets trending, and what can our audience do to manage that better? So maybe, yeah, why
So
don't you go
for
ahead?
us, I talked about profitability, and I want to extend our streak to 48 profitable quarters, which I think we'll do. And so one way to keep our yield is to lower our operating expense. One way to do that,
Mm,
obviously, is to grow your portfolio faster, so your denominator is higher. But another way is to leverage that technology so you do more with less. Um, and we've gotten there's things that are out of your control, like all of our leases came due after COVID, so we were able to consolidate our entire real estate portfolio at once and offer work from home for our employees. That saved us about $10 million a year in our real estate costs. That lowers our OpEx quite a bit. We have some new technologies on the origination side of our business, which is allowing us to scale up quite a bit and not have to hire employees. So the bots are doing the processing of STIPs and verifications. I already spoke about the technology on the back end of the business, which is allowing us to collect more with less employees. That lowers your OpEx. And there's some other cost-cutting moves that we're doing internally to sort of offset the rising interest rate pressure that we have.
Sure, sure. All right, we're actually getting close to time. Maybe in about the last minute or so, Pushan, we're curious of a question here. Have you had to hire more collectors in recent times, or do you foresee that you will need to as demand or like workload increases for them, or do you think mostly your workforce would be stable?
No, I mean, we of course will have to hire more collectors. One, because obviously delinquencies is one factor. The other is that we are also rapidly growing. We managed to grow our portfolio about 20 to 25% year on year, and that's the expectation even this year for sure. So of course, as we
Yeah.
continue to grow, we will have to hire more and more collectors. Is it hard to find them? Of course it is. We are a remote first company, so we are hiring nationally. So people work from home, and wherever we find them, we'll take them. But I think the point that Mike made about technology is very, very important. I think the only way to stay ahead in the game is to adopt and assimilate whatever technology you can find. And there's so much of it that has come about, right? I mean, like Prodigal is a great example of that. I mean, I kind of met Shantanu when he was making the business plan outside of a lended conference many years ago. So and there are so many other companies that even 8 9 years ago were not even they didn't have any production or whatever, but now they have got such great products. Some of the stuff that Mike is also talking about. So we have to invest in technology. Obviously the pace is different. Some companies can do it faster, some companies have to do it slower depending upon their own balance sheet and growth aspirations and all that kind of stuff, but we have to keep thinking about technology for sure.
Yes, makes a lot of sense to me. All right, well, this time flew by. This took us to the end of our 30 minutes for today. So I want to remind the audience this was recorded, so you'll be able to listen to this back. We'll also share that with everybody who has registered. So just before we wrap up today, I wanted to thank both of you for joining and sharing your time. Thank you for that.
Thank you for the invitation.
Thank you, guys.
Definitely. All right. Have a good rest of your day. And to everyone else, we hope to see you in a future webinar.